Chapter 7. I think basically we talked about the different modules. Okay, talking about financial reporting fraud, who commits it, uh, why do they do it, and common reasons that senior management might overstate, and then common reasons why they might understate performance in the financial statements. And how do they commit it? We talked about that, and we'll talk in greater detail in a bit. And then we talk about public versus private companies. We talked about, did we talk about this? No, we didn't. Okay. Oh, that's right. This is the beginning of Module 2. We ended with Module 1. Now let's go about Module 2, again, which goes into accounting principles. And again, this is material that I'm sure you probably had in one of your intro courses to accounting. So I'll just fly through a lot of these slides. Okay, so we've got some concepts in accounting. We have assumptions that we're dealing with an economic entity that's a going concern. Okay, that this company or entity will continue on into the future. Once it becomes clear that it's not going to, then our accounting rules kind of fall apart, because then the asset values that are recorded in a set of financial statements, for example, suddenly they have no meaning. If we know that in 6 months they're going to have to, sell off those assets, for scrap, now suddenly their values are a lot less. So the idea that it's a going concern is very important. We're always dealing with some monetary unit in the United States. It's the dollar. In most of continental Europe, it's the euro, etc. And this is a word that's always fun to say, periodicity. Okay, is that we measure things in chunks of time, months, quarters, years, etc. Right, and so that they're comparable or comparable, if you will. Certain principles we have deal with the recording of items at historical costs, if for no other reason that those are much easier to verify than simply, hey, what's the market value? Revenue recognition, we have rules about that. Matching revenues with expenses, and then full disclosure. Okay, think about financial statements. Key audiences are the shareholders, and then also creditors. And well, they have a right to know what's really going on. But we have some constraints on our accounting, such as the cost benefits. Okay, we may theoretically come up with a best theoretical cost, but trying to get at that number might just cost too much. We have some number we're trying to get, maybe a certain expense, and it's just too difficult to get. Though our technology is allowing us to do that. For example, even at Governor's State, if a lot of photocopy machines. It used to be you just had the photocopier and you copy whatever you want, and then there would just be one big photocopying expense on your on the school's financial statements. But now, before you can get that machine started, you have to enter all sorts of information, if nothing else, who you are. So those expenses can be traced back to you. And some places you have to enter who you are, what the particular job is you're working on. I know there were law firms I was at where you'd have to enter the client and what particular engagement with that client you're working on, so that the costs, the expenses can be billed to that client. So the technology has allowed us to trace those costs better now than in the past. But there's still a lot of costs and a lot of expenses, a lot of other things that we simply, it costs too much to get at that number. So we drop back 10 and punt. So we use a shortcut when it's just too costly. We also have the idea of materiality. Okay, like some numbers just aren't big enough for us to worry about. We follow industry practices. So different industries have different rules of accounting. I was talking to someone recently who is an accountant in the movie industry. And the movie industry has its own rules of accounting, as does the oil and gas industry. So they follow a company practice, which is not always the same as what we do generally. And then the idea of conservatism. Also one of the constraints. So we try to if we have a choice of numbers to go to, we always choose the more conservative number. We have qualitative characteristics of relevance and reliability. You got some data. That's great. What's the data? It's how many people with green eyes work for the company. That's great. It's completely irrelevant, but fine. And reliability. Would a second person be able to trace that number back to that source and get the same number? And again, two things that are important for just the use of accounting data is it has to be comparable. Okay, comparability. Some pronounce it whatever the other way. Not comparability, comparability, and consistency. Because so in order to compare this year's financial statements to last year's, you need these qualities as well. Okay. Oops, and I just defined all these things. So let's just skip over this slide since I already talked about all of them. Okay. I've forgotten that these next few slides were exactly that. So who is responsible for financial statements? Good question. It really is. I may have mentioned this before, maybe not. Woe be the financial statement auditor. A shareholder will get, in the past, they'd get it in the mail, a nice set of financial statements, usually with a glossy cover and all sorts of stories about how great the company is. And then the financials, the numbers, the notes, and at the end, there's the opinion of the auditor, signed off by whomever, PricewaterhouseCoopers, Deloitte, etc. And very often, shareholders think, they're the people responsible for the financial statements. And they're not. The folks responsible for financial statements, here you see at the top of this, it's company managements. Okay, company management is responsible. The auditors, shall we say, merely audit the numbers. There were surveys done in the past and show that so many shareholders believe that, I guess they think that company management walks into Deloitte with shoe boxes full of receipts and say, here, put together our financial statements. No, companies have their own accounting departments that do all that. Okay, and then once their financials are completed, then the auditors get to look into them. So some years back, the opening language of a standard audit opinion was changed to spell it out clearly that management is responsible for these financial statements. We merely audit them. I don't think they used the word merely, but okay. Then they did that survey again and found that the numbers really didn't change because nobody really reads the opinions. They just see the name of the big accounting firm and figure they're responsible. So sadly, folks have to learn what the role of the auditor is. In any event, company management is responsible, and as I say, it's hard to fathom how financial statement fraud can be committed, especially anything material, without some knowledge or consent of management. Okay, it can happen, but I would say without some knowledge, consent, or almost criminal neglect. It's they weren't doing anything to look out for it or to ensure it didn't happen. So again, fraud is generally instigated by members of management, especially we're talking here financial statement fraud. The board of directors, who they're not involved in the day-to-day operations of the firm. They get together every month or so, get reports from top management, but they're responsible for setting the tone, setting the culture of the firm, along with senior management. Okay, so they're concerned about the tone at the top. Does the company's top management and the board emphasize integrity, emphasize ethics? We know that companies that do generally have a lot fewer problems with fraud of all kinds. Okay, because high integrity leads to more honest employees. Well, let's face it, the more dishonest, it helps encourage employees to be honest and stay honest, and also deters or sends away those who want to be less than honest. So who use financial statements? There you go. All those folks listed there. And so the company's owners, whether that be one person or a couple of million shareholders, lenders, vendors, customers, and investors. How do they use them? Increase the apparent prosperity of the organization, dispel negative perceptions, and judge employees or management performance. Often important with regards to fraud cases. So here's our typical flow chart on how accounting activity gets recorded and then spread out to the users, who then make their decisions based on those financials, whether it be approving a loan, making an investment, approving credit, etc. Okay, here are our types of financials. You all know them and love them, especially those first four: the balance sheet, the statement of income or statement of operations, statement of retained earnings, statement of cash flows. Now, those are our big four. Then we get into statement of changes in owner's equity, statement of assets and liabilities that does not include owner's equity, statement of revenues and expenses, summary of operations, statement of operations by product line, statement of cash receipts and disbursements. Now, those first four are the ones that make up the, shall we say, the usual set of financial statements, the financial statements that shareholders, for example, are entitled to get. The others are often for specific purposes, say, getting a loan, especially if the loan is going to be collateralized with some assets, etc. Okay, but those are a fairly common set of financial statements. Other types: prospective financial information. So what do we expect in the next quarter and next year? Pro forma financial statements, where you have a certain form to fill in. Proxy statements. So then if there's a proxy fight in a company, say over the control of the board, there's going to be financial information in that, along with interim financial information, current value financial representations as opposed to historical value, and then personal financial statements. Okay, if you're applying for a loan, you might need to fill out a personal financial statement. One of the things I did the summer that I worked for one of the big accounting firms, they had us shifting between the different divisions, and they had a division that did personal financial statements for very, very wealthy people. Whoa, fun. Okay, then, now if they're not so wealthy, or they are wealthy but they made a bunch of bad decisions, you get bankruptcy financial statements, and be careful with those because you have to file them with the bankruptcy court. And if you have fraud in that, that's a very special section of the federal code to punish people, criminal charges for lying to the bankruptcy court. And then registration statements, we register a class of securities with our friends over at the Securities Exchange Commission. Okay, now then, we generally talk about GAAP, right? Generally accepted accounting principles as used in the United States of America. But there are other bases for accounting. Government or regulatory agency accounting. Yeah, coming up on tax day, tax accounting, whole different animal, right? So this tax basis of accounting, but elsewhere, other government agencies or regulatory agencies have their own ways of accounting. So if you are for example, a utility company, the different regulators there have their own things that they're interested in. So you give them a set of financial statements in accordance with the rules that they've established. Likewise, the cash receipts and disbursements or modified cash receipts and disbursements method, sometimes it's called the cash basis. A lot of even large accounting firms and especially law firms use the cash basis. They're more interested in, how much cash did we generate so that the partners can withdraw some and have a good life. I tell this story often. Back in my single days, I dated a young woman who was a junior partner at one of the big law firms in the city of Chicago. And New Year's was coming up, and it's like, hey, we got plans for New Year's. Well, her plan for New Year's Eve, as she was like the bottom of the totem pole for partners, was to drive around Chicagoland, and before 5 o'clock when businesses close, pick up checks from their clients who still owed them money, because according to their financial statements, the revenue didn't get recorded until they collected the cash. So if they wanted to make their firm look like they made revenue that year, which was the basis on which the partners got their bonuses, they had to collect all the cash they could before the clock strikes midnight. And then after that, she would drive out to their homes, and sometimes very nice homes out in the fancy suburbs. And so, as I said, I was dating her at the time. So that's how I spent New Year's Eve with her. And then when it got to be about 11:30, we had to hightail it downtown to the Northern Trust Bank that keeps a window open, has one entrance and a window in there. And it was amazing. You see all these, usually the younger lawyers, come scrambling in just before midnight to make the deposits. And as long as they got in through the door by midnight, before they closed the door, they recorded the cash that they were depositing as having been received on December 31st. So it would go towards that company's revenues for the year. But again, it's because it was the cash basis. Again, there's also other bases that have a definite set of criteria applied to all material matters. Okay. Now, what are the different types of financial statement fraud schemes? 5 categories: concealed liabilities and expenses. Okay, that's again, and when you think about financial statement fraud, the big problem is you're pulling something off, you're getting away with it until you can't anymore, and then the company has to say file for bankruptcy, and the shareholders are ticked off because they've invested a lot of money in that firm that now they're not going to get any money back, or get only a fraction of the money back. So one of the ways we've seen companies do that, where they have big liabilities and expenses, but they lie about them until it's too late, until they catch up on them. And then, for example, if they owe a lot of money to a couple of creditors, sometimes what the creditors can do, the creditors can get together and they can file a petition in bankruptcy court to force an individual or a company into bankruptcy. Okay, so they, usually, it could be just one, but if you get a group of creditors and they get their lawyers together, they file a petition with the bankruptcy court. A summons is issued to the company to come into bankruptcy court and to explain why the court should not find them to be bankrupt. That's not cool. Next is fictitious revenues. You really didn't make the money, but we got to just kind of make up some numbers, make it look good. Improper asset valuations, okay, especially, most cases involving this is you're overstating your assets. So especially if you have loans taken out using the assets as collateral. Improper disclosures. You're supposed to be disclosing certain information in financials and you're not, or you are, but you're doing it improperly. And then timing differences. So again, with revenues, you've gotten revenues that should be recorded in the following year, but you kind of move it back to the year before so that year before's financials look better. Again, these categories are shown in that wonderful fraud tree developed by the Association of Certified Fraud Examiners. The distribution of these scheme types has been shown to be fairly uniform in various ACFE studies. Okay. And there's a case study in your book involving my friends at Crazy Eddie. I think I asked you to watch the Crazy Eddie and Sam Antar videos before, but you saw what they were doing. Okay, they started out basically ripping off Uncle Sam by not reporting sales revenue and then not paying taxes on it. But then they got the idea, hey, let's go public with the stock and make real money. And then things turned around, and so you see all these different types of schemes that they used in order to make the company look like they were making a lot more money than they were, so that the stock prices would go way up. And it worked for a while until, as I say, until Eddie Antar was caught by his wife cheating on her, and then she and her relatives who owned stock in the company sold the stock to a group of investors who thought Crazy Eddie would be a great company to take over. And those investors got the 51% needed to take over the company. And once they did, they found out what was really going on. So a lot of moral lessons in that story. Again, more with Crazy Eddie. I'm just going to go through this because, again, I think those videos are a very good way of seeing how they did it. Okay. And again, how did the auditors let it happen? That goes in, that's covered in those videos. Lessons be learned. Okay. A lot of lessons we learned, including don't cheat on your wife, especially if she and her family own a lot of stock in your company. But just don't cheat on your spouse, husband or wife. Even sophisticated investors don't read footnotes. Footnotes are notes of the financials. This is, as I've said before, I have limited respect to a lot of folks on Wall Street. And one of the things comes to this. We accountants put together these financial statements and we audit them and make sure those notes are comprehensive and cover everything back in the back. And they don't read them, except those who do often figure out when there's something bad going on and are much more attuned to which way this company is going to be turning. Wall Street's got a nasty name for such people, and they're called bottom feeders. Because what they do is they go in and they see a company, they read those notes, and they go, hey, this company isn't going to last much longer. So let's sell short the stock, okay? And when the company does collapse, they make a lot of money. Again, they say the audit was poorly planned, poorly executed, and poorly supervised. Plus, you had Sam Antar, who worked who was the controller of Crazy Eddie, worked for the audit firm that they used, and that was deliberate from the start, and knew exactly how they conducted their audits. Crazy Eddie had weak internal controls, and because of these relationships, the auditors were just too trusting. Okay, let's go look at these schemes. Adelphi Communication, another scheme from a couple of decades ago, and Timmy Regas engineered financial manipulations when he was CFO at Adelphi, and they started with overexpansion in the late 90s. And you see this a lot. Companies will, spend a lot of money, leverage a lot to, buy a competitor, get a bigger chunk of the market, but they over leverage to get it. All right. So you've got they buy Century Communications for $5.2 billion with a B dollars, and then a couple of years later, in the new millennia, in July of 2002, here comes the Securities and Exchange Commission. They charge Adelphia with, among other crimes, fraudulently excluding over $2.3 billion in bank debt from its consolidated financial statements. Oops, they left out all those loans they got. Only $2.3 billion. Right? So now, again, we talk about these 5 different types. And we saw that before. And so let's define financial statement fraud. The deliberate misstatement or omission. We saw that with Adelphia. They didn't misstate it so much as they just left it out. Deliberate misstatement or omission of amounts or disclosures of financial statements. It should be on financial statements. Done, to deceive financial statement users, particularly investors and creditors. Following the Enron case came SAS number 99, the consideration of fraud in a financial statements. Okay. And we in 99 did a lot of things. It really brought back auditing back to its roots when the practice of professional auditing started. Really at the turn of from the 19th century into the 20th century, it was all about looking for fraud. Okay, and then we got away from it, and we stopped. We're like, well, we don't have to worry about that. We're going to worry more about revenue recognition and things like this. But 99 says, no. You have to think about fraud almost constantly during the course of an audit. At the beginning of the audit, we actually, 99 requires you to call together a meeting of all of the staff who will be working on that audit and have a brainstorming session to think up ways, now that you sort of know the client, how could fraud be committed? Who could be committing it? What would be the red flags that we should look for? And then tweak your audit procedures so as to look for those red flags. So the 2 big ways of committing fraud: misstatement arising from fraudulent financial reporting. That's mostly what we've been talking about here. But also misstatements arising from the misappropriation of assets. And that is to say, theft. Okay. I like to use the word defalcation every now and then. So, and again, here's some of our schemes that we like to talk about. The falsification, alteration, or manipulation of material financial records supporting documents or business transactions. Right? That's the beginning of any accounting entry, is some sort of business document or recording a transaction. So we falsify it, we alter it, we manipulate it. Material intentional omission or misrepresentation of events, transactions, accounts, or other significant information from which financial statements are prepared. Okay, so you at the end of the year, you needed to boost your revenues to make your company look better than it really is. So you kind of deal with another company, maybe it's a good customer of yours, and say, hey, tell you what, we're going to ship 10 truckloads of of our product to your factory on New Year's Eve, and we'll record it as a sale to you. Then, celebrate New Year's, watch some football, and on January 2nd, you ship it all back to us. In fact, we'll even park the trucks in your parking lot and then just ship it on back to us and return it. And we'll give you full credit for the return. Well, the idea is we'll record that as a sale, as a revenue for the previous year. Yeah, that if you don't disclose that that's what you did, that's fraud. Deliberate misapplication of accounting principles, policies, procedures used to measure, recognize, report, and disclose economic events and business transactions, and the intentional omission of disclosures or presentation of inadequate disclosure regarding accounting principles and policies and related financial amounts. So you change the manner in which you record, I don't know, depreciation, but you don't disclose it. And maybe there's no good reason to do it except this way. It makes your expenses go way down and makes your subsequent net income look a whole lot better. So what are the costs of financial statement fraud? Well, researchers state that more than 50% of U.S. companies in 2000, so we're going back a ways, were victims of fraud with a loss of more than $500,000 on average. So this is some years ago. Then, and it's funny, Enron, in a weird way, it did make a lot of headlines, but it also occurred in 2001, just about the time of the terrorist attacks. So they kind of fell off the front page. But the collapse of Enron, and that was massive, this should be alone, is estimated to have caused a loss of about $70 billion with a B in market capitalization to investors, employees, and pensioners. Now, the worst part of Enron, I think, was Enron management telling, and they were a big growth company, telling all of its workers, hey, put all of your investments and your pension money in Enron stock. We're doing great. And then the whole thing collapsed. And people who either were getting ready to retire or did retire now had to go back and get jobs because they were dirt poor. Okay. Researchers report that shareholders lost. Okay, and then these all took place like within the same year. Enron, WorldCom, Quest, Global Crossing, and Tyco, based in Illinois, Tyco, altogether lost about $460 billion. That's a lot of money. Also, respect for accountants went down in the annual Harris poll. However, it bounced back after about 2 years. So despite this, I think people realize, there's a couple of bad apples, but for the most part, accountants are okay. These studies and the related statistics provide only estimated direct economic losses resulting from financial statement fraud, but there are also many indirect costs, right? So, when a factory needs to close down because of an accounting scandal, well, yeah, all those people at the company are laid off. But what about the restaurant across the street or the diner across the street and all the other services and businesses that were able to survive because of that factory? Okay, other ways that financial statement fraud is harmful and again undermines the reliability, quality, transparency, integrity of the financial reporting process, jeopardizes the integrity of the auditing profession. And again, it went down for a couple of years and polls bounced back. Here's the big: diminishes confidence in the capital markets, makes capital markets less efficient, adversely affects the nation's economic growth and prosperity, and results in big litigation costs. It should be costs. Okay. And there's more, but we also know in other studies that nations that have good, strong rules of accounting and strong rules regarding auditing financial statements have faster growing economies than those who don't. this, if you looked at a lot of the nations, especially like in Eastern Europe, after the fall of communism, and they started adopting capitalist systems, those who adopted strong accounting rules generally had greater and quicker economic growth than those that did not. Okay, also 7, destroys careers of individuals, causes bankruptcies by the company, and encourages regulatory intervention. Oh, we don't want that, right? And that this messes things up. Though it's, to some extent, it is necessary. Causes devastation of the normal operation performance of alleged companies. Well, they are companies, those who supposedly involved. Raises serious doubts about the efficacy, let's say the effectiveness of audits, and erodes public trust in the accounting and auditing profession. Okay, one moment, please. Sorry about that. I was hearing this strange noise going on behind me, and turns out my cat was back there, knocking things over. So I was going to have her say hello, but she just ran out the door. That's why I stopped. Okay, I'm back now. All right, moving on. So let's talk about a few of these schemes. One, fictitious revenues, recording sale of goods or services that just didn't occur, or they did occur, but not in the numbers that were reported. So artificially inflating or altering invoices of legitimate customers. So remember our rules of revenue recognition. Revenue is recognized only when the revenue is, and this doesn't make it easier to define, when it's realized or realizable, and when it's earned, here are the criteria that have to be met for that. Persuasive evidence of an arrangement exists, delivery has occurred or the services have been rendered, the seller's price to the buyer is fixed or determinable, and collectibility is reasonably assured. So we have a current conceptual guideline for revenue recognition. And this is FASB Concept Statement number 5, Recognition, Measurement, and Financial Statements in Business Enterprises. And number 6, the elements of financial statements. This is part of the process by FASB and the IASB, the International Accounting Standards Board. Something we've called the convergence process, because some years, a couple of decades ago now, the big accounting firms wanted America to essentially adopt the international accounting standards. And much like during the Carter administration, when the Carter administration said, okay, America is going to be on the metric system now. Good try, right? Didn't work. People didn't want to do it. And so we still have, we have 2-liter bottles of pop, but that's about we still get gasoline in gallons, not in liters. I guess you go to the liquor store, you'll see a 750 milliliter bottle of hooch. But for the most part, we didn't get adopted. Why? Because people said, no, we're not going to do it. The accountants of America did the same. The big accounting firms were pushing for it. Why? Because they've got the international clients that had to, create essentially 2 different sets of financial statements, one under U.S. GAAP and one under the international accounting standards. And so, IFRS, by the way, International Financial Reporting Standards. So, they said, okay, America, we heard you. We're not going to force you to, plus every accountant and CPA in America was essentially being told, hey, you're all going to have to go back to school and relearn accounting. And that didn't go over well. So what they did instead is, the Financial Accounting Standard Board in the U.S. and the International Accounting Standard Board said, okay, we will, and it's been going on for decades now, go into the conversions process where we will sit down and slowly go through those differences in our accounting principles and practices and try to converge them to one common thing. And this was one of the things they worked on, is this concept of revenue recognition. So they got together and they did a good job. The updated guidance on revenue recognition can be found in FASB's Accounting Standard Codification number 605 and 606. There you go. All right. So here's a sample or an example of fictitious revenues. Okay. So here we got a 350. You apparently bought some fixed asset for $350,000. Okay, on December 1st, and then we've got. We're also recording a sale of $350,000 with accounts receivable for $350,000, and then we also, clear out that accounts receivable by saying we received cash, and this is 2 weeks later. I forget exactly how this example works in the book, but I'm sure you all read it, so I'm sure that makes a lot more sense to you than it does to me. So this is one of the things I talked about, a sale with a condition. So we booked that sale, those, 10 truckloads of goods going out to that, really good customer of yours. But some terms have not been completed, and the rights and risk of ownership have not passed to the purchaser. You may remember from your business law class, those things, free on board, FOB, okay? And that was all about, at what point in handing the goods over to the customer does the title to the goods pass? Well, the sale is not considered to be, consummated, complete, until that title has passed. So if you, ship, 10 truckloads of goods up to your customer and just park them outside their fence on December 31, you did not sell those to them, okay? But it's all recorded in an effort to fraudulently boost a company's revenue. And they do not qualify for recording as revenue until conditions are satisfied. And again, we see this occur in companies where they're very cognizant of what Wall Street and other analysts say their company is supposed to be reporting for their year. Let's assume they're on a calendar year. And they're running short. So in the beginning of December, they say, we have to make a lot of sales this month. And, unless you're selling Christmas trees, may not get them all. So you start playing games. Now, the good part for auditors and fraud examiners is that generally we only have to look for this towards the end of the fiscal year, because that's when they're doing the push to get those revenues to look good. So you got that pressures to boost revenues, external pressures to succeed, gives the motivation. Loan requirements, we've talked about this before. Provisions in a loan that say you have to, report numbers like this, or we can call the loan in and make you pay us immediately, or take you to court to collect the cash. Or we'll change the terms of the loan. We'll charge you some more interest. Plus you have to, pay a, I use this number because I was involved with this, or I saw this. The bank, said, okay, no problem. We'll just change the terms of the loan. But according to the loan, every time we do it, we charge you $350,000 to cover our costs. Now, their costs are simply, striking the number on the loan agreement and writing a new number on it. But they say it costs them $350,000. And anyway, so you don't want to do that. Um, Pressures to commit financial fraud can also be internal. You have departmental budget requirements, or you just want your division to look good. So what are some red flags? Rapid growth, unusual profitability, inability to generate cash, okay, from operations, but you're reporting big earnings. Wow, you would think if you're reporting big earnings, you'd be getting the cash too, right? Now, sometimes you don't, but look into it. That's a red flag. Again, red flags don't mean there is fraud. It just means go looking for it. See if there's any there. Significant transaction with related parties or special purpose entities not in the ordinary course of business. That was the big problem with Enron. They had these special purpose entities out there. Significant, unusual, or highly complex transactions. And that's really to sort of confuse the auditors and others. So we're going to move this here, and then we move it there, and then we got to take a such and such, and yeah. No, shouldn't be that complicated. Unusual growth in number of days sales in receivable. Oh, wow. Yeah, boy, we really, getting a lot of receivables and we're not collecting on them. Well, maybe they're fictitious. Significant volume of sales to entities whose substance and ownership is not known. Now, who are these people? Okay. Enron was creating entities named after Star Wars characters. Good times. And then unusual surge in sales by minority of units within the company. So, why isn't the folks that usually generate most of our revenue generating all this revenue? This little side business that nobody really deals with is making a lot of money. What's going on? All right. Now, timing difference is one of the biggies. There might actually be genuine sales going on, but they're going on in January and February, but you're recording them in December, okay? Or you've got, you spent a lot of money in expenses in December, but we're not going to record them until January, all right? So you shift revenue or expenses between one period and the next, again, to increase or decrease earnings as so desired. Then we have, the matching principle. Remember, we're supposed to match revenues and expenses in the same accounting period. Failure to do so, and you're violating, the matching principle. So step one, using the revenue recognition principle, you record the revenue in the appropriate period. Yay, you did good. Step two, you're supposed to match the expenses with those revenues in the same period. But if you record the revenues in December, but you don't record the expenses until January, you've now overstated net income at year end. And you're also going to be understating net income in the following year. But hey, you got 12 more months. Don't worry about it now. So here we've got a fraudulent transaction posted before year end. And the book describes what's really going on here. And then the project is started and completed amazingly in January. All right, we're just going to go through some of these, and it shows here, how this mismatch can cause material misstatement in your financials. So here we've got year one and year two. Let's just look at the bottom line there. So the incorrect year one shows a $17,000 net income, and in year two, $13,400 loss. Well, year one should be zero, and year two should actually show income, but you've shifted things around. So, you do it, everyone's happy. Whoa, year one and a year one, 17,000. And then what you should do, if you're in on this, get your resume out before the end of that next year when they report a loss. So going back to the idea of revenue recognition, you generally recognize revenue when the sale is complete. And it's amazing this, the staff accountants at the SEC some years back issued accounting bulletin number 104. And this is what we hang our hats on as to what is a complete sale. Persuasive evidence, delivery, price is fixed or determinable, and collectability reasonably assured. Okay. Again, when revenues are recorded in the wrong period, they inflate net income in that period in which they're reported and underreport income in the following period. Evidence that an arrangement does not exist. There is no agreement, or either written or verbal. It doesn't have to be a written agreement necessarily. It doesn't have to be like big old sales contract. It can be a verbal agreement. It could be just a purchase order. It doesn't have to be a big, fancy, sealed, notarized agreement. Now, if it's a huge sale, yes, it is. But small, no. But there has to be something, that there's been a meeting of the minds. Okay. But other evidence, or at least a red flag, they say, oh yeah, well, we got a verbal agreement. Yet throughout the year, every other agreement was written. A written order exists, but it's conditional upon sale to the end user. Okay, so you're selling, a bunch of things to your customer, but your customer says, oh, okay, but it's conditioned on us being able to resell this to our customers. A written order exists, but contains a return, right of return. Okay, and this is that 10 truckloads that get returned the next day, or on January 2. Written order exists, yay, but there's a side letter that alters the terms in ways that eliminate the required elements. And the transaction is with a related party, the fact of which is not disclosed. Okay, so it's you sold it to another division of the company, for example. Not cool. What about that idea of delivery not occurring or services not rendered? The shipment has not been made, and the criteria for recognized revenue on billed and hold transactions have not been met. There can be situations where you have, made a sale, but the customer calls up and says, hey, I don't have any room in my warehouse right now. Just hang on to it, but it is ours. And some of the criteria are like, yeah, the title of the goods has passed to me now. Okay, to the customer. Fine, but we're sitting on it. We're holding on to it. Okay, that's fine. But that's, again, red flag. Shipment has been made not to the customer, but to the seller's agent, to an installer, or to a public warehouse. So, hey, the auditors come around, the stuff is gone, but didn't go to the customer. Some, but not all of the components required for operation were shipped. Okay, so you're selling them at, let's say you sold them a car, but it's missing the engine. Okay, that's not good. Items of the wrong specification were shipped. Again, it's the end of the year. You want to make that sale look good, so you ship them whatever you got. But it's not what they wanted. Delivery is not complete until installation. The customer is able to test it and accept it. The services were not provided at all. Services are being performed over an extended period of time. Only a portion of service revenue should have been recognized. So if it's a 6-month service contract that was signed December 1, no, you don't get to recognize all 6 months of revenue. And the mix of goods and services in the contract has been misstated in order to improperly accelerate revenue recognition. All right. What about that idea of the price being fixed or determinable? That's a fun word to say. So the price is contingent on some future event. Okay, so especially if it's that the sun rises tomorrow, yeah, that's pretty determinable. Let's hope so. But if the price is contingent on, and you see this every now and then, right? They have these contests where you come to the furniture store towards the end of the year, And if we get 6 inches of snow on Christmas Eve, your furniture is free. Guess what? The price is contingent, okay, on that future event. Generally, the way they do that is they book the sale, and then they have an insurance policy, because there are insurance companies that will write policies covering, insuring those sales to reimburse the customer if there's 6 inches of snow on Christmas Eve. The transaction includes an option to exchange the product for others, or the payment terms are extended for a substantial period and additional discounts or upgrades may be required to induce continued use and payment as opposed to switching to alternative products. Okay, so it's okay. You don't have a settled price in these situations. Collectability, not reasonably assured. Again, collection contingent on some future event. You know, like I win the Powerball. Yeah, no. Yeah, that doesn't sound like a collectible contract. The customer doesn't have the ability to pay. You know, they file for bankruptcy. Now, maybe shortly after, they might be able. Maybe all their debts will get relieved by the bankruptcy court, but for whatever reason, they don't have ability to pay, and yet you made a sale. Not cool. What about long-term contracts? Remember, we have the completed contract method, where you don't record revenue until the project is 100% complete. In those cases, construction costs, and they say a construction company, the costs are held in inventory account until completion. Percentage of completion, you recognize revenue and expenses as measurable progress is made. These are vulnerable to manipulation. So what you want to do is sort of front end load the revenue, right? And can be used to prematurely recognize revenue and conceal contract overruns as well. Channel stuffing, I love that term, or sometimes called trade loading. The sale of an unusually large quantity of a product to distributors. So again, come December 1st, your company realizes you're going to have to book a whole lot of revenue, in this next month to, meet expectations. So you get on the phone, you call all of your, customers, and you say, tell you what, we're going to send you triple the amount you normally order just to get out of here. And, we won't bill you for it, for 120 days. And even then, you may not have to pay for it, or we'll give you big discounts on it, whatever. Again, using whatever techniques to get your customer to overbuy, deep discount, extended payment terms. Attractive in industries that have high gross margins. Yeah, you push that stuff out the door, boom, big net income. But you're stealing from the next quarter's sales. It also raises questions about the collectability. So it's, again, the red flags indicate that could be fraudulent, not necessarily, but could be. Again, recording expenses in the wrong period. You're under pressure to meet projections and goals, and you don't properly match it against the income. So you sold, $1 million worth of inventory, but you don't record the cost of the goods that you sold, which is an expense until January. All right. Red flags with these timing differences. Again, rapid growth, especially right towards the end of the year. Doesn't generate cash you'd expect it to generate. Complex transactions, unusual increase in gross margin, especially compared to peers, growth in the number of days sales and receivables, and decline in the number of days purchases and accounts receivable. Accounts payable. Yeah. What about hiding those liabilities and expenses? Okay, again, can have significant impact. Easier to commit than falsifying sales transactions. And 3 common methods for concealing. And that's if you're doing auditing, like assets, those are easy to confirm. The asset's either there or it's not. And, you can ask for the title to it and yeah, okay, you bought it and it's here. How do you confirm a liability? As I say, an asset is, you have bank accounts. You mail a confirmation to the banks and the banks write back, yep, all the money's here and it belongs to the client. Okay, great. Liabilities, you'd have to theoretically write every person in the world and ask, hey, does my client owe you money? All right. Not easy to confirm. So 3 common methods. Just omitting the liability expense, capitalizing an expense. Okay, so you have an expense, but instead of doing the full 100% of the cost of that expense as that cost of that item as an expense this year, you capitalize it and spread it out over the next 5-10 years or however many. Failure to disclose warranty costs and liabilities. Okay, contingent liabilities, bad stuff. Okay, omission, easiest, is the easiest method. Among the most difficult financial statement schemes to uncover. Because again, you're trying to confirm a negative, essentially, right? Perpetrators often believe they can conceal their fraud into future periods. And you can, but eventually it catches up with you. And the thing that often happens when they're doing this is those that are owed the money, if they get wind that, hey, we just looked at the financial statements and there doesn't appear to be enough liability on there, and I know, and they talk amongst themselves, it's not always we talk about big business, but it's in many ways a small community, especially in particular industries. Everybody knows each other. They go to trade shows together and go, hey, that company owes us a lot of money. Well, they owe us a lot of money too. And they owe me a lot of money as well. And they get together and go, just amongst us, we have $1.5 billion in liability, and yet their financial statements only listed $250 million. And that's when they get together and walk down the bankruptcy court and force you into bankruptcy. All right. You can only get away with it for so long. Now, the capitalized expenses, I think I may have mentioned this before in this class. If not, I will now. One of the companies we talked about before at the time of Enron was WorldCom, or known as MCI WorldCom, telecommunication company. One of my favorite schemes that they did is they owned microwave towers all over the United States. You see them as you drive down the highway, those big towers with looks like radar dishes on them and that bounce microwave signals between each other. Well, they transmit, amongst other things, telephone calls on them. And if you look up at the top of those towers, you'll see those red flashing beacons up there. Essentially a big, bright light bulb that flashes so that airplanes don't fly into them. So those things burn out, and they send a crew out, and they go up there, and these particular bulbs are not cheap, but they burn out all the time. It's an expense, people. And so the cost of those bulbs should have been expensed in the year that they get installed or purchased. Instead, MCI decided, what we could do is let's capitalize them. And then rather than taking let's say they spend, $10 million a year on these red flashing bulbs, let's capitalize them and depreciate them over 10 years. So now, instead of a $10 million, expense against revenues, it's only going to be $1 million. And so you simply expensed you capitalize an expense and then you reduce the amount of the expense to a fraction of it through depreciation. So there you go. And then returns and allowances and warranties. The expense associated with sales returns and customer allowances. Record the expense should be recorded as a contra sales account. In doing so, you reduce the amount of net sales. And again, estimated warranty expenses should be accrued as a liability. And it's not always an easy number to come up with, but you look at, how many times have you had to, replace or repair something because of the warranty, and then you figure out what the future warranty expense is going to be. Another big one there is litigation expense. Your company's getting sued, and you're probably going to have to pay big dollars. Maybe you've already got a judgment against you. Somebody say, we're not going to record it until we get to the Supreme Court. Yeah, you got to record something. Okay. So here's some of the red flags. Again, inability to generate cash, but you're generating revenues. Asset, liabilities, revenues, expenses that involve subjective judgments are the most difficult to corroborate. So estimates, right? Our friends over at Waste Management a few years got caught in that thing when they decided that, all those dumpsters they have around the United States, and it's like millions of dumpsters, instead of depreciating them over 5 years, we'll depreciate them over 10. Just giving you, I forget exactly what numbers they had, but yeah, suddenly the depreciation expense was cut in half. I don't know, how long does a dumpster last before it rusts out? So non-financial management's excessive participation in selecting of accounting principles or determination of significant estimates. That is, when you see, the head of marketing is involved with accounting principles, something's going on, okay? Unusual increase in gross margin in excess of your industry peers. The allowance for sales returns and warranty claims that are out of line with industry peers. I mean, is your stuff really all that good compared to your industry peers, that no one's returning it? A usual reduction in number of days purchases and accounts payable, and reducing accounts payable while competitors are stretching out the payments. Okay. Disclosures. Again, they're supposed to prevent the users of financial statements from being misled, because the numbers alone don't tell the whole story. However, again, and this is me bashing Wall Street, our friends on Wall Street hire all these, whatever you want to call them, bitheads, computer jockeys, who come up with these algorithms. And as soon as a set of financial statements are released, and companies will release them either after hours, right as the markets close, or early in the morning. Okay, and then the guys take those numbers from the financial statements and drop them into these algorithms, and it kicks out a number which they say this is the price that stock should be traded at. Okay. Did you read the notes? Of course not. They didn't have time to. They didn't take the time to read the notes. Well, maybe those notes indicate that revenue is not sustainable. Well, they don't know. All they did is plug in the numbers. Well, the notes, disclose this stuff, or supposed to. So improper disclosures include liability omissions, subsequent events omitted, management fraud, related party transactions, and accounting changes. And again, if you don't read the notes, even if a company, properly disclosed that stuff, you wouldn't know about it, and you've mispriced that stock. So liability omissions, for example, failure to disclose loan covenants. You know, what's a covenant? Well, agreements that the borrower has promised to keep as long as the finance is in place, such as ratio limits or restrictions on other financial agreements. Okay, so yeah, we'll, you know, and you can understand a bank will say, okay, we're going to give you a whole lot of money, but we want to make sure that your current ratio, you know, is at least this. Okay, or you can't, you know, go out and get any more loans, you know, with using your assets as collateral. And again, the punishment is that we can call the loan. We can make you pay. You know, you thought you weren't going to have to pay this loan for 10 years. We'll make it collectible immediately if you violate those covenants. And if you don't pay us right back, we walk into court, we show the judge the contract, and the judge will say, that's it, you know, pay the money. Or what I like is you get an order from the court to seize the money. And I've done that. It's fun. Let's see what else we got. Failure to disclose those contingent liabilities. Again, I've been in the American Bar Association Business Law section, Law and Accounting Committee subcommittee on contingent liabilities. There is such a thing. And determining at what point do companies have to disclose contingent liabilities, especially arising out of litigation. And a lot of debate on that, because the lawyers and the accountants, you know, are often, I mean, the CPAs, the auditors want it out there. They want it disclosed. The lawyers don't. Very often, because they know if the company discloses that, oh yeah, we're going to have to pay, you know, $20 million on this lawsuit. As soon as that goes into the notes, some other lawyer is going to read that and go, what? They got $20 million on a lawsuit because of, you know, product liability? I'm going to get a bunch more, get a bunch of other folks who've been injured by this product, and we're going to sue the pants off that company because it's lucrative. So the lawyers don't want it out there, mostly to protect the client from additional lawsuits or from larger dollars in a settlement. And but the auditors are fighting to get it disclosed. It was an interesting time in that committee. Subsequent events. Events occurring or becoming known that may have significant effect on financial statements. Okay, I think we're seeing going on right now in the Middle East a lot of subsequent events. Okay, where, hey, my ship got, you know, boarded, or we can't get the oil through the Straits of Hormuz, and therefore, you know, our revenues are going to be whatever. But it can be smaller things. It could be, as we saw last evening, a tornado, you know, takes out the factory. You know, well, don't put in the financials, or people will realize we can't, you know, make the revenues we made last year. Well, that's not right. Subsequent events, okay, should be disclosed. Fraudsters often avoid disclosing court judgments, and again, you can do some public record searches. Can often reveal the information being withheld. And then management is committing fraud. Okay, maybe management knows about it. Maybe they found out that their CFO was embezzling. Okay, what do they do? Well, they don't want the embarrassment, so they fire them. Maybe even gave them a good recommendation, but they don't disclose it. Or maybe they're still with the company. All right, so withholding such information likely involves lying to the auditors, which in fact is a violation of the Sarbanes-Oxley Act. Okay. Related party transactions. Okay, business with entities that are significantly influenced by the company. It's essentially, there's, you know, if a party is so closely related, is essentially self-dealing. Okay, maybe you're selling stuff to that related party at a substantially low price. Okay, or at a large price that you can't sell to anyone else, but that's okay. You end up showing big revenue. So it's legal as long as you disclose. Okay, as we said about um, any kind of conflicts of interest. The key is undisclosed conflicts of interest. So disclose it and you can get away. But why do you disclose it? You have to disclose it in the notes to the financials. Because the transactions are supposed to be arm's length transactions. Tyco, Illinois-based company, got caught up in that a couple of decades ago, again, due to related party transactions. By the way, side note here, I mentioned, I believe, when we were talking about illegal gratuities last week or the week before, the mayor of Portage, Indiana, and who was prosecuted by the U.S. attorney in Indiana. I think the trial took place in Hammond, Indiana, the federal courthouse there, and he was found guilty of violating the federal anti-bribery statute. Eventually took the case to the U.S. Supreme Court, and it was in fact a case not so much a direct bribery, here's the money, now give me the contract, as much as an illegal gratuity. I got the contract, and now I will give you a whole lot of money, which is illegal under a lot of state statutes, including Illinois. Indiana did not have such a statute, so they brought it under the federal Anti-Bribery Act. Supreme Court said, well, we're looking at that statute, the Federal Anti-Bribery Act, and no, it has to be sort of this quid pro quo. It's like, give me the money, and now I'll give you the contract. To give you the contract and then later give him the money, that's not covered under that law. So he was acquitted after going through all of that. Okay, the trial, all the pretrial stuff, the trial, the appeals, the Supreme Court. All right. Took almost 10 years. Well, he ends up with, of course, a United States attorney who is not happy with him. And they can be like a bulldog with a bone. And so they prosecuted again. But this time, I'm trying to remember what it was. It was like misleading the Internal Revenue Service about this money that he received. And what was the nature of it? Was it a consulting contract or not? And blah, blah, blah. He was found guilty of misleading the Internal Revenue Service. And yesterday, the day before, the judge in Indiana sentenced him to 3 years of probation. So he got to go home. And as long as he's a good boy for the next 3 years, the probation ends and he's a free person. So he can live his life, just don't violate the law. And one of the things that the judge cited was, this guy's life has essentially been wrapped up in litigation for the last 10 years, and therefore she didn't think it would be appropriate to send him in prison, because the U.S. attorney wanted to send him in prison, but she gave him 3 years on probation. So just a side note there from a case I referred to a week or so ago. Moving on. Now, accounting changes are governed by what we call FASB, but it's really Statement of Financial Accounting Standard number 154 on how you deal with an accounting change, and can involve accounting principle changes, estimates, reporting entity. A fraudster may not restate if the change causes the financial statements to appear weaker, right? So they have the rules of change, and you get things like changes in the rules on pension disclosures, etc. And they go, hey, this is going to make us look bad, so let's not adopt. Oh, we'll say we adopted, but let's not restate the financials to be in compliance with this change in accounting principle. Well, the problem with that then is that your financial statements are no longer comparable to those of another company who did, in fact, honestly adopt the new principle and made the restatement as necessary. Okay, red flags with this. We got 2 slides on that. Again, improper disclosures. Most folks in the accounting department don't get involved with the disclosures, right? So it's usually a single person or a small group of really top people, okay, who control this. If you have an ineffective board of directors or an ineffective audit committee, who have supposedly should have oversight on financial reporting, this is one of the reasons why. Excuse me for a moment. I'm going to hit the mute button. Okay, hopefully that my voice is better. One of the reasons Sarbanes-Oxley says now that all boards of directors have to have a financial expert on the board. As I said before, the original draft said it had to have an accounting professor, which would have been great, but there's not enough of us to go around. So it's a financial expert, and I've been a financial expert on various boards, usually after they've had some scandal, fraud. They say, let's get Cressy, Professor Fraud, on our board. So, because in the past there have been boards where you've got some really great folks on there, and I'm thinking of some boards would have like retired sports stars, okay, who didn't know anything about business or finance or accounting, but it looked good to have their name on it. One of the biggest surprises I ever saw was I was doing an audit on a company that was a division of a company called Signal Companies. And one of their board members, again, we're going back decades, was, what was his name? I just had it and I forgot it. One moment. All right. Gene Autry, the old singing cowboy star that was the original singer of Rudolph the Red-Nosed Reindeer. He was on the board of directors of this big conglomerate. And they were having a board of directors meeting at this division headquarters in the Chicago area. And it was amazing. The board is showing up in limos, and black limos. He pulls in with a big white limo, steps out. It's got this big white Stetson cowboy hat on, and a white cowboy, suit with the sparkles on it and all that, and white boots. It was something to look at. And I was thinking, oh, he's going to be like some of these boards have got sports stars on. They're just going to sit there and read the paper and not paying attention to anything. Boy, was I surprised. This guy knew business inside and out. It turns out he made a lot of money in the early days of movies and the talkies and such. And he bought up a lot of land in Orange County, California. And he was on top of every dollar. He, for a while, also owned back then, the Anaheim Angels, because they were in Orange County. But that guy himself could be a financial expert. But going back, if you have a board that's made up of people that don't know what's going on, they're being maybe led around by their noses by someone in the accounting department who is not doing proper disclosures. Again, ineffective communication, implementation, support, or enforcement of the firm's ethical standards, rapid growth or unusual profitability, especially compared to others. And that's one of the things you want to do. Find out who are the peer companies for this company, and constantly look at their numbers and compare it to your client's company, and you can get that information from both, just the publicly disclosed information from those other companies, but also from trade organizations. Every industry has a trade association. One of the things they do is compile information from all of their other members. And then significant, unusual, or highly complex transactions. especially close to the year end or period end, that pose those difficult substance over form questions. More red flags. Again, significant related party transactions, not in the ordinary course of business, with related entities that are not audited or audited by another firm, but that's kind of putting shade on the other firm. Significant bank accounts of subsidiaries or branch operations in those tax haven jurisdictions for which there appears to be no clear business justification. So why do we have bank accounts in the Seychelles Islands or in Malta, right? Overly complex organizational structure involving unusual legal entities. That's what happened at Enron, or managerial lines of authority. Known history of violations of securities laws or other laws and regulations, or claims against its entity, its senior management, or board members alleging fraud or violation of law. The big auditing firms, before they will take you on as a client, will ask, does any of your members of your board or your management, have they ever been arrested or convicted of any crime, any felony, or any crime alleging moral turpitude and fraud? And if so, the big four firms will say, I don't care how much you throw at us as an audit fee, we're not taking you on as a client. Recurring attempts by management to justify marginal or inappropriate accounting based on materiality. Oh, the numbers aren't that big, let us get away with it, right? And then formal or informal restrictions on the auditor that inappropriately limit access to people or information. That was in the news recently, dealing with essentially the agency that handles Voice of America and things like that. They have an outside auditor that came in and looks at their books, and they recently issued their, I was going to say issued their opinion, but actually issued their non-opinion. One of those rare cases, they issued a disclaimer of opinion. And they said that basically their records and non-cooperation made it unauditable. And so they issued a disclaimer saying that we cannot complete the audit due to a scope limitation. So that was in the news just like 2 or 3 days ago. That was what's her name? Carrie Lake, who's the head of that agency now. All right, moving on. Improper asset valuation. Again, misclassification of long-term assets as current assets. Okay, window dressing, because it always looks better when you have good current assets. Again, then companies then calculate the current ratio. It looks good. Well, if it's not a current asset, it shouldn't be listed as a current asset. Other, improper valuations, inventory valuation, accounts receivable, business combination, and long-term assets. Again, inventory, remember, supposed to do lower of cost or market. Well, what if that, market went down? Well, that's okay. We'll just keep it at the higher cost. And then you have things like manipulation of physical inventory counts. If you watch those videos regarding Crazy Eddie, you'll see that going on. Inflation of the unit cost used to price out inventory, failing to relieve inventory for cost of goods sold. So you're selling stuff, but you're just not reducing the inventory. Or just phantom inventory. Again, I think Crazy Eddie had all those. Accounts receivable, again, should be reported at net realizable value. So they have, so again, you got this fictitious accounts receivable, common at the end of period accounting, right? And at the end of the accounting period. False confirmation of balances being sent to the auditors. Again, there's a fun thing. That's the thing, if you mail out a confirmation on accounts receivable, it has to be received directly to the offices of the auditors. It does not go back to the company and then the company hands it to you. No, that means you're going to send out a new confirmation. You cannot trust that. Failure to write down accounts receivable. Again, it's required to accrue losses on uncollectible receivables and record impairment of long-lived assets and goodwill. Okay, you didn't write those down. On accounts receivable, uncollectible receivables, very often I had a situation where the client said, oh, we've got a new collection firm. They're a whole lot better in collecting, so we're not going to write down receivables as much as we used to in the past. And really, were they, breaking kneecaps or what's going on there? As it turns out, they were just very effective, and it was true. So they didn't write down as high a percentage of receivables as they had in the past. Business combinations. When you take, or if you've taken, if you haven't, if you take advanced accounting, you'll learn all about this stuff and how when a company, combines with another company, how you allocate the purchase price between tangible and intangible assets, and the changes in goodwill accounting. Companies may still be tempted. The rules on this have changed significantly. And so they may not even know that this is what they're doing, but they can over allocate the purchase price to in-process research and development assets, or establish excessive reserves for various expenses to release at a future date. So it's why they call it advanced accounting. It's very advanced. What about those long-term assets? Well, like all things, there's booking the fictitious asset. Just say, yeah, we've got this big asset out there that we own. See it? It's a big building. We have a big office building. Yeah, that's what we have. Okay. Because company assets are often physically found in many different locations, this fraud can sometimes be easily overlooked. Oh yeah, we have a warehouse out in, Sparks, Nevada. And I say that only because I had an audit client who had a warehouse in Sparks, Nevada. Okay, good enough. How do you confirm that? Well, as I say, fortunately nowadays you confirm its existence. Give me an address. I can look it up in Google Street View and I'll see if something's there. Well, do we know it's theirs? Or is it somebody else's warehouse? Well, fortunately, you can do a lot of looking online. If it's theirs, well, then there should be some. If it's real property, there should be a county assessor who would have records showing who owns it. But again, it can be difficult. Very often, what you need to do is, if you're not one of the big firms, you've got offices everywhere, you're going to have to find a corresponding accounting firm out there in Sparks, Nevada, and say, hey, would you do me a favor? My client's got this huge asset on its books that's in Sparks, Nevada. Go out, see if it's there. Look up in the county records, see if they own it, and we'll move on from there. And we'll send you some money for it. So you engage them. Misrepresent the asset value. Again, it should be recorded at cost. Again, if it's real property, there should be some record filed with the county. Many financial statement frauds have involved the reporting of a long-lived asset at market value instead. Big problem with Enron. Let's see. Understating assets, in some cases, it might be advantageous to understate the asset. Again, if management's deciding, okay, we're going to understate everything, make the revenues look bad, stock prices go down, then we're going to buy up the stocks ourselves and take over the company for ourselves. Okay. Again, can be done directly or through improper depreciation. Capitalizing non-asset costs. So excluded from the cost of a purchased asset are interest and finance charges. Those should be charged to interest expense. But if you capitalize it instead, that's wrong. Misclassifying asset. Okay, so you misclassified into general ledger accounts in which they do not belong. And that manipulation can skew financial ratios that might be involved with those loan covenants and borrowing requirements, right? Again, going to the idea that the loan covenant says you have to have a current ratio of this, and you don't. Well, take that long-lived asset, make it a current asset, and suddenly you don't have to worry about that covenant. Red flags. recurring negative cash flow from operations, or an inability to generate cash flows. And nonetheless, you're reporting some great revenues. Significant declines in customer demand and increasing business failures in either the industry or the overall economy. So if the rest of the economy is going to hell in a handbasket, but they're doing great, you have to wonder about it. As I think I mentioned, when MCI WorldCom was manipulating their financial statements and looking wonderful, AT&T was reporting problems, and the board of AT&T fired, I think, 2 or 3 CEOs because they weren't able to keep up with MCI WorldCom. Well, it's because MCI WorldCom was cheating. Okay. Assets, liabilities, revenues, expenses based on significant estimates that involve subjective judgments or uncertainties that are difficult to corroborate. And then non-financial management, excessive participation or preoccupation with the accounting principles that are used. So again, keep those marketing and other people out of the accounting department. Unusual increase in gross margin compared to their peers. Okay. Unusual growth in number of sales, days sales and receivable. Unusual growth in number of days purchases and inventory. Allowance for bad debts, excess and obsolete inventory, and similar measures that are shrinking in percentage terms or otherwise out of line with the industry peers. Unusual changes in the relationship between long-term assets and depreciation, and then adding to assets while the competitors are reducing capital tied up in assets. All right. Whew. How do you detect these things? All right. So we have 5 of them there: vertical analysis, horizontal analysis, ratio analysis, analysis of cash flows, and analysis of those non-financial numbers. Okay, now a lot of this you've probably already encountered, so let's fly through them. Okay, good old percentage analysis. Okay, vertical and horizontal. So now the vertical analysis, and again, hopefully in some of your classes you've encountered this. Technique for analyzing the relationship between the items on the income statement, balance sheet, and statement of cash flows by expressing components as percentages, often called common sizing. As opposed to horizontal analysis, technique for analyzing percentage change in individual financial statement items or accounts from one year to the next. So you start with whatever year you want as a base year. And then, if more than 2 periods are presented, each period's changes are computed as a percentage of the preceding period. Again, these are good for finding red flags for big fraud. Immaterial frauds, maybe not. Okay, but then they're immaterial. So here we got our balance sheet. Okay. A little bit of Coke, zero sugar there. This week's sponsor. So here we're going to do a vertical analysis for the balance sheet for this company. So we see in year 1, here are the numbers, right? Cash, 45,000, accounts receivable, 150, inventory, et cetera, et cetera. So we're going to use the total asset and total liabilities and owner's equity number, 330,000. That's going to be 100%, right? And then off of that, all those other line items, we're going to divide by 330,000 to get a percentage. So we see that cash is 14% of total assets, accounts receivable 45%, inventory 23%, and then the long-term assets net 18%. And then we see, the liabilities and owner's equity below that. Cool. Then we have the second year. So we got last year's numbers, we got this year's numbers. So here's this year's numbers, and we see that the base we're going to use again, total assets, total liabilities, and owner's equity. It's now $425,000. Okay, well, cash has gone from $45,000 last year to only $15,000 this year. But more significantly, it's gone from 14% of total assets to 4%. Accounts receivables remain pretty much the same. Okay, as far as percentage goes, 45 to 47. Inventory up significantly. Long-term assets down. So total assets have gone up. Okay, yet that cash is a problem. It's a problem. So, and then we look at the liabilities and owner's equity. We see that last year accounts payable were 20. It was not 29%. It's now up to 51%. Long-term debt from 18 to 14. Okay, common stock 8 to 6. Paid-in capital 23 down to 18. Retained earnings from 23 down to 12. So then we see what's the horizontal change for each of those accounts. And we see that, well, the cash is dropped by 67%. Accounts receivable, 33%. Inventory, all right, is 100% higher, okay, from last year to this year. And, we see the big changes. So what, once you do this as part of your audit, part of your fraud investigation, you talk to the other members of your team and go, anybody know what would account for this? And if you can't, then you bring it to the big bosses and you go, okay, what the heck is going on here? Okay. Especially with accounts payable and cash. You're just, your accounts payable have gone up. Your cash has gone way down. What's going on? All right. Then you can do the same for the income statement. And then we use the base as the net sales. I think a lot of you knew that already. So here's you have year one. Next we have year two, which apparently year two net sales is $4,050,000. I think they put the comma in the wrong place. It'd be 450,000. All right. And so there's your net sales number. And we see, again, looking at the changes, okay, so net sales has gone up 80%. Cost of goods sold, though, has gone up 140%. Gross margin has changed 20%. And let's see what else we got in there. But net income has dropped 267%. Again, go to your colleagues, ask them, and then ask the company. Okay. Vertical analysis indicates the relationship of or percentage of component part items with respect to a specific base item. Thus, it emphasizes that relationship among statement items within each accounting period. Horizontal statement analysis uses percentage comparisons from one accounting period to the next. Ratio analysis is a means of measuring the relationship between different financial statement amounts. Traditionally, financial statement ratios are used in comparison to an entity's industry average. When the financial ratios highlight a significant change in key areas of an organization from one year to the next, or over a period of years, it indicates there may be a problem. Ratio analysis is limited by its inability to detect, again, fraud in small, immaterial scale or amounts. Again, this is, traditionally ratios are big. I'm not sure they're as big as they used to be, just because we have so much data out there now we can analyze. But they're still pretty strong, especially with regards to those covenants in loan agreements. And this is why it's important that the company you're investigating or auditing or examining is a member of a trade association, because then those trade associations will give you those industry-wide ratios. And so you can, compare your company to that industry. Of course, you have to make sure you pick the right industry. All right. So here's a list of some of the key financial ratios. I'm sure you've come across all of these in your accounting study so far. Current ratio, quick ratio, receivables turnover, collection ratio, blah, blah, blah. You see them all there. Okay, let's look at a few of these. And unfortunately, These slides did not come out right. So I'm going to have to just, skip over them. I'm not even sure I'm not sure what these are supposed to show. Thanks, authors. Again, the DuPont expression, this is developed by the good folks at DuPont de Nemours, the chemical company. DuPont expression is an analytical approach that dissects the income returns into its component parts. It's often applied to return on equity. The approach can also be used to examine return on assets. And they'll say, well, let's look at two. Okay, well, unfortunately, again, I don't know what's going on with these slides. So I'm sorry, folks. We're just going to have to skip over that. Cash flow analysis is key. Despite all of the advances we've made in so many things, with, Bitcoin and, cryptocurrency and all sorts of other stuff. I'm sorry, cash is still the reigning king. And if you ignore cash and don't analyze cash flow, you're making a big mistake. So financial statement fraud often creates an unexpected and irreconcilable difference between income and cash flow, especially cash flows from operations. Because you can make up all the numbers you want in the income statement, but those cash flow numbers, those generally get confirmed, especially the ending balances, by banks, third parties. So you have to somehow manipulate that number. So cash flow should be examined in relation to a company's reported income over time. And again, in comparison to competitors in that industry and that industry's averages, which again, you can get from, if not from the financial press, then from trade associations. Also, non-financial numbers, known lovingly as NFMs, include production facilities, retail outlets, production capacity, weather data, and the number of employees. Those are less vulnerable to manipulation as they are often independently verifiable. Okay, so when a company issues its financials, and say it's a retail company, and they'll report, oh yeah, well, we've increased the number of our retail outlets. Did you? Or we closed a bunch. Did you? Or because of problems with the weather. I'll tell you, if you go down to the Chicago Board of Trade, they've got all the displays there of what the various commodity prices are, and then they also have a huge big screen TV with the weather forecasts on it. And I'm sure the traders today and yesterday were trading based on the weather. Okay. Now, this time of year, Chicago area, not so much a problem. In a few weeks, it will be. Further south, it is. One of the things they look at, especially in the West, is snowpack. Is there enough snow on the mountains so that when it melts, there'll be water in the rivers? That's a huge influencer. So a lot of this stuff, these numbers, again, are not subject to the kind of manipulations that can go on in a company's accounting department or wherever in the company. So NFMs must correlate with the performance to serve as an effective benchmark for evaluating financial statement data. So researchers suggest a minority of auditors use NFMs as an information source for testing and do not increase their reliance on them when they point to a fraud red flag. The presence of high fraud risk alone is insufficient to increase auditor consideration of inconsistent NFMs. Auditors are able to react appropriately to an inconsistency if they are effectively prompted, and the influence of a prompt on auditor reliance on NFMs and account balance expectations is stronger when the fraud risk is assessed high. The authors really feel that MFMs should be used a lot more by auditors and fraud examiners than they currently are. Okay. How do you deter financial statement fraud? How do you keep these people from lying on their financial statements, especially in so many cases when they are, personally, and say, they've got a close interest in that. As I say, 50% of compensation to highly compensated executives is through bonuses and stock options that are, go up if the financials look good. So they've got reason to manipulate them. How do you deter it? Well, it's more complex than just deterring asset misappropriation and other frauds. Okay, so we can put up cameras. We see you stealing, we're going to fire you, we're going to sue you, or we're going to get you arrested. If you're manipulating the depreciation on an asset so as to get the financials to look better, or any of these other schemes that we've just been talking about the last few hours, how do you, it's not so easy to detect. How do you deter it? Again, 89% of financial statement frauds involved either the CEO or the CFO. Okay, so these are the folks way up at the top. Executives use their authority to override most internal controls. Again, one case I was involved in where the CFO ended up, wearing an orange jumpsuit, was able to overpower everyone in the accounting department, and even overpowered members of their board, and cowed them, if you will, which is sad to see, because they brought me in. They didn't put me on the board as others have. They brought me in as consultant, and it was like, you folks are top business people in this region, and you got flim-flammed by this person and overpowered and overwhelmed by them. Yeah, I guess we did. It happens. All right. So, a general approach to reducing financial statement fraud: reduce the pressure to commit it. Okay. Reduce the opportunity to commit it, and reduce the grounds for rationalizing financial statement fraud. Again, that kind of goes to our old fraud triangle, right? The pressure to commit a fraud, the opportunity to commit fraud, and then being able to rationalize it. How do you reduce the pressures? Establish board oversight of the tone at the top created by management. Board and senior management. Again, some of this is kind of like, we should have good tone at the top. Fine. But if the CEO and CFO is committed to committing the fraud, they're just going to laugh at all the tone at the top stuff, right? Board and senior management should offer their own actions as examples of appropriate conduct. Avoid setting unachievable or unreasonable financial goals. Hey, AT&T, okay? Stop firing your CEOs for not meeting the goals of a fraudulent company. Avoid applying excessive pressure on employees to achieve unrealistic goals. Change the goals if changed market conditions require it. Yeah. I can't think of the word, but outside pressures, okay? The economic world of today is vastly different than the economic world of a couple of years ago. So the goals should be changed appropriately. Ensure compensation systems are fair and don't create unwarranted incentive to commit fraud. Discourage excessive external expectation of future corporate performance. Remove operational obstacles to effective performance. I would say another, okay, these are the reduce the pressure. Okay. How do you reduce the opportunity? Again, internal control. Okay. So maintain accurate and complete internal accounting records. Carefully monitor business transaction and interpersonal relationship with suppliers, buyers, purchasing agents, sales representatives, others who participate in transactions between financial units. We know this can be a problem, okay, when they start colluding. Establish physical security systems, secure company assets, including finished goods, cash, capital equipment, tools, and other valuable items. Including now, they're fairly cheap. Putting GPS, units or responders on items. Okay. Divide important functions among employees, sharing control of one area. Again, segregation of duties. Maintain accurate personnel records, including background checks on new employees. And it's funny, and I understand the reasoning. One of the most effective things you can check on someone's background, we've talked about fraud and the idea that so many perpetrators are first time, is looking at their credit scores. But in Illinois, for most employees, you can't do that. But you can if they are in a position of trust over financial stuff. So, but various studies point that that's a very effective thing to look at. Maintain, okay, blah, blah. Encourage strong supervisory relationships and leadership within groups to promote enforcement of accounting procedures. Establish clear and uniform accounting procedures with no exceptions clauses. Left out of that, again, and I go back to this case I was involved in when the CFO ended up being sent off to federal prison. They got away with overriding all the controls and everything else and bullying people. And they didn't have a system where someone could report it. You have to have whistleblower protection and a system for reporting fraud and suspected. Everyone in this accounting department knew this was going on or knew that at least this was questionable, but nobody reported it because there was no mechanism to report it. So you have to have that reporting structure in place. And again, the last, rationalization, right? The fraudster, classic case, can rationalize what they're doing. So again, promote strong values based on integrity throughout the organization. Have policies that clearly define prohibited behavior with respect to accounting and financial statement fraud. If you don't have it, people can say, well, you never said I couldn't do that, right? Provide regular training to all employees and communicate prohibited behavior. Okay, I think this should have been in the last slide, but establish confidential advice and reporting mechanisms for communicating inappropriate behavior. That's more of a prevention tool than a rationalization tool. But have senior executives communicate to employees that integrity takes priority and that goals must never be achieved through fraud. And of course, they're not going to call it fraud. You say, so if we have to take some lumps on Wall Street or lumps with the banks or whatever, then we're going to take them. But we're a better company than that. We will turn it around. We're not going to manipulate the numbers. Manipulation is a much better term than fraud. Ensure that management practices what it preaches and sets an example by promoting honesty in the accounting area and clearly define the consequences of violating the rules. And you don't have to shame the person, but if a person is caught violating the rules, it's like, okay, we're separating you from us. You're fired, okay? And get out of here and don't expect to get a good review or good recommendation. And again, you be careful what you say. You don't want to, some say you have to tell the other workers that you fired them for, committing fraud. That's a good way to invite a lawsuit right away. So, be careful. Talk to your lawyers as to what you can say. But if somebody's let go, you can let them go and say, there were things that we found out that caused us to separate them from the company. It kind of hints at it without getting yourself involved in a defamation lawsuit. Okay. Whew. Long chapter. Finally, the copyright sign.